Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture as we kick things off for the last week of September. A lot still to watch out for as we look forward to more jobs data and also China's Golden Week. So what should investors be keeping an eye on? Let's check in now with Mel Siew. He is the portfolio manager for Asia Public Credit for Muzinich Co. Mel, good morning. How are you doing today?
Morning. I'm doing great. How are you?
Awesome. Great to have you on as we count down to a couple of things. Let's start first with what's at the top of your list when it comes to tracking what might move markets. And it looks like what's playing out in the U.S. could be definitely one to watch out for in terms of the U.S. government shutdown. And it's a story we've heard before. How significant is this and how big of a risk is this for markets?
Yeah, so this is something that comes up every so often. It's, I guess, a unique feature of the US economy and the governance there that they sort of every few months kick the can down the road with a US debt ceiling. It does have some impacts this time around. Everyone's looking at the data. The Fed are very data dependent. And the government shutdown would lead to delays in those data releases. We're already seeing a slight erosion in the quality of the data. The Federal Reserve and Bureau of Labor Statistics say that there's more estimations going into the data. So a delay will, at this critical time when we're all looking and scouring data for signs of how the economy is doing, I think won't help.
Yeah, everyone's trying to read between the lines, and of course, without the data, it makes it a bit more difficult. Talking about data, one of the potential data points that could be affected will be the jobs data, the non-farm payrolls data at the end of the week. And that's an area that the Fed has been saying, is a concern for them to look at even more than inflation. Walk us through what you're getting or reading into the labor market in the US these days.
Yeah, so it's been a bit of a puzzle, right? So we've had revisions taking the numbers lower. We had a very big revision that happens once a year that basically trues up broader survey data versus the sort of limited samples that they have on a month-to-month basis. So the job growth has been pretty underwhelming. At the same time, you could explain that by saying that US immigration policy is a lot tougher than it has been in recent years, and so you're not getting the supply in. So you've got lower demand but lower supply. So you take the ratio of those two and you get the unemployment rate. The unemployment rate has ticked up slightly, but not the huge way that you would expect with this underwhelming jobs growth. Against that, the US economy has done pretty well, I would say. Q2 GDP on the latest revision got revised up from 3.3 to 3.8%. So economy is still going along very robustly. A potential explanation for that is it's really one sector or related sectors that is leading to this strength. It's all the AI investment, the data center investment. You also have utilities investing very heavily to supply that power. Because when you dig into other parts of the data, so for instance, the labor diffusion index, which basically looks at the number of companies adding jobs and compares that to the number of companies that are not adding jobs or losing workers. That is pretty weak, actually. And it's been tracking at the weakest levels for several years, which suggests that, there is this one large theme sector in the economy, US economy, that is very high profile and lots of attention and lots of focus and spending is going on that. But the rest of the economy is perhaps not doing so well.
Yeah, so there is that part to consider. Talking about the government shutdown earlier, that will be a can they have to kick down the road by Tuesday night US time, so we'll get some inkling of it perhaps on Wednesday morning or afternoon Singapore time. All right, let's take a look at what you've just talked about, which is a rather resilient US economy. Of course, in the air as well is tariffs. We've had another round over the weekend, the Trump administration focusing on pharmaceuticals as well as furniture. So that's the latest wave of tariffs. Mel, how much is being factored into these latest data points? Are we perhaps seeing some level of front loading before things start to really moderate in some sense?
Yeah, so that's what we saw in the Q2 numbers. I would say, the US trade deficit has actually increased because of the imports that have increased whilst the tariff pause was underway. So I think that effect is largely done. It's interesting on the pharma side, there wasn't that much reaction. There's, I think, a recognition that a lot of the pharma companies have got US based production. And a lot of the imports would be in generics, which are much lower cost. Although the headline number is quite high, the impact should be pretty limited there. And also, if you break it down, it's really the value added that's outside of the US. So to the extent that there is IP, historic IP, that is in that value that was created in the US, then that would be out of scope for tariffs, right? So the headline number looks pretty scary, but actually, when you drill down, it may not be that bad, at least in the pharma sector. The furniture one is harder to localize that. So, there's a lot of furniture exports here from Asia that go into the US. So that is a bit of a different one, and that you may see some impact. But it's interesting, you haven't really seen, you've seen a limited impact in terms of the inflation numbers, but you haven't seen anywhere near the large impact that people had feared. It suggests that it's being absorbed.
Yeah, lots of potential effects to watch out for, including the latest saga around the H-1B visas, which makes it harder for some tech companies to hire talent. All right, let's take a look at the other end of the spectrum where we've got China in focus. In fact, China's not going to be in action much this week because of the Golden Week. So what's in store here?
This year, it's interesting. It's a continuous 8-day period. So they have the Mid-Autumn Festival holiday as well. So they've combined the two. So it's a slightly longer Golden Week holiday. It's always well watched because of the consumption trends that we see. People take the opportunity to travel, spend time with family, domestic tourism or outbound tourism. What we may see this year is, or we're looking for, is maybe some initial impact from the wealth effect. The Chinese stock markets have done very well over the past 12 months. A large part of Chinese house assets had been in property. We know that is a sector that has not done well, but it's slowing down. And potentially there's been the gains from financial markets have offset the losses on property. So it'll be interesting to see whether there is a boost to consumption more this year because of what we see as improving balance sheets and a wealth effect.
Yeah, Mel, so heading into the final quarter of the year, how has the markets been moving and where is it heading towards in terms of capital flows for at least the next few weeks?
We talked about the Federal Reserve. They just started cutting. The expectations are for, you could say, 1-2 cuts this year. They talk about rates being still restrictive and getting back to neutral. So that has been a trend this year. It's been hard to argue against a lot of people, investors, allocating towards time deposits, money market funds, short-dated government bonds because rates have been higher. But as those front-end rates come down, we have seen increased interest in corporate bond funds, especially short-dated corporate bond funds, where you're not going out into really long maturity bonds, the front end. So that is a theme we expect to continue. And if you look in other parts of the world as well, central banks are also been reducing in Asia and in Europe. So that is a theme we expect to continue. And emerging markets have done well, not just local currency, but also the dollar denominated part of emerging markets. And that is something we saw interest pick up around the middle of this year, actually. And so we expect that to continue. And with emerging markets, it's interesting. You can get exposure to US dollar rates and that dynamic in terms of the Fed cutting, but you also get a different geographic risk profile, right? So you're not exposed to the US, you're exposed to dynamic growing economies in emerging markets that we think are doing very well.
All right, a great snapshot of where things are going and also a look at what's in store for the rest of the week. We've been in conversation with Mel Siew. He is the portfolio manager for Asia Public Credit at Muzinich Co. Mel, thank you so much for your time and insights.
Thank you much. Thanks for having me.
All right, catch up with you again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.